when I started losing money, that's when I realized, maybe I should be putting my money towards something else. Because honestly, I couldn't believe that I was losing. I just assumed that I would be good at it because usually when I, put a ton of effort into something to try and learn, I usually end up being able to get good at it. And I couldn't do that with this, and so I just couldn't believe it because I'm like, man, I'm a learner. Like, what am I doing wrong? So that let me know that my process was wrong because I was working way too hard and not seeing consistent fruits from all the labor that I was putting in. So, to make a long story short, or a longer story shorter, I learned from my trading school. I took these classes, and now I have a process that I can believe in. It's a lot of work, and it may not be what's the word? Um, attractive to some people to actually learn, but the difference between this and anything else that I had learned, because I was at YouTube University for a long time, and the difference between this is that this school in particular is founded by, and the senior mentors, they're all former professional traders. And what do I mean by that? I mean, they used to work for the big banks that and their track record, their careers are actually verifiable on government websites. Like you can look up one on the U.S. website, U.S. government website, another one, a bunch of others you can look up on a UK, United Kingdom website. Another one's on the Australian website because the guys are from all walks of life, in all different areas across the globe. But the thing that's most common with them is they were either hedge fund managers or they were um, traders at big banks, and they had to be licensed. So, in other words, they had certifications to say that they are allowed to do what they're allowed to do. So imagine these guys working for big banks, and then they decide to, after the great financial crisis of 2008, the housing crisis in the United States, after that ended, they decided that they were going to, um, they didn't like the way that they had to trade anymore. So because they didn't like the way that they had to trade anymore, they had to trade way different. It was way less risky, and it wasn't really them being allowed to pick and choose everything that they wanted to trade. At that point, after the financial crisis, because the U.S. economy took such a big hit, the traders at these banks, and the banks are a business, they put their traders into a position where they were essentially market makers. So they were just taking the other side of other people's trades, and they didn't like it, which I wouldn't like that either. I'd rather do some work, put in the work, and then pick what I want to pick, trade what I want to trade. And that was what they wanted to do, so they made a school. And I took the classes, and now my process is thus. Dang, I talked way too long just to get to this point. Okay, so essentially, I look for um, I determine my macroeconomic bias. So I go through all these leading indicators that I learned at school. It's a bunch of macroeconomic data. I get it for free. Well, excuse me, I don't get it for free from my school. I actually, after I took my classes, I decided to re-up, and I have a data subscription at my school, a data subscription, and it's which is the same as the Discord subscription. They're essentially the same thing, and it's just a place where you can speak to other people in the trading community that have taken the classes, along with the mentors as well, and the senior quantitative analyst. He's the guy who compiles all the numbers together, makes all the spreadsheets, gathers all the data for us, and then disseminates it to each one of us so that we have a copy of it. I literally download data almost every single day. Depending on, things that I'm looking for, but it's a bunch of data that will help me come up with my macroeconomic bias. So the bias that I want to have in my portfolio. Do I want to be net long or net short or neutral? And I got to tell you what that means real quick. It's basically my portfolio. Well, I trade a long and short portfolio. I don't just trade everything in one direction. Remember, I spoke about diversification earlier? I trade in both directions, and the time frame that I trade in is the 20 to 60 day time frame. So because I'm trading in a 20 to 60 day time frame, I'm utilizing that sweet spot of time frame where it matters, where the fundamentals of a company matter, the macroeconomic data for the entire market matters. And also, timing is less, timing is important, but that's less of a emphasis on the timing just because there's more of an emphasis on doing the work, understanding the company. So macroeconomic data, that's broad. I determine my portfolio bias from the macroeconomic data, and sometimes I'll be able to determine where to start looking for a stock. Then from there, once I narrow down where to start looking for a stock, I look into microeconomic data. I look into the actual um, companies themselves, and I do a bit of quantitative processing. So just processing the numbers and doing the work to try and determine why the stock market thinks that a particular company is attractive for my long ideas, and why the stock market think that a particular company is not attractive for my short ideas. After I do that quantitative processing, then I go into the qualitative, and I'm trying to determine specifically what uh, what drives these valuations of the company. So I learned what drives the valuations of a company. Once I have that, then I go into trying to time the trade. And I say trying to time the trade, but if I'm being totally honest, I spend the least amount of time on this and the most amount of time on the quantitative and the qualitative work regarding any particular stock because I want to ensure that I know what that company is, what makes them attractive, what makes them tick, what drives their valuation, like how the market perceives them, what drives it and I want to make sure that I'm choosing the right stocks that go up and the right stocks that go down because my portfolio volatility is completely smoothed out based on how many trades I have on. Like, okay, for example, right now I have on four longs and four shorts. I have on four long trades and four short trades. And because I have on that many trades, my volatility in my portfolio, the up and down fluctuations or swings, it's more smooth because of the way that I'm trading, because I'm actually diversified. And that's why I don't have any fear of my account blowing up or going crazy, but apart from all that, I also they give us a trader statistics, performance and statistics and track record sheet, and we keep track of all of the trades that we make. We keep track of the trades that we currently have on and the ones that we've closed. And from there, when we lose the trade or whether we win a trade, the best part is being able to choose a catalyst, something that will move the stock in that time frame that we choose and knowing like and getting a big move in the stock and understanding that okay, this is why it happened. You know what I mean? I because I know why the move happened, whether I win or lose, if a big move happens, I'm like, okay, I'm doing something right. I'm identifying good catalysts that can move the stock in my time frame, and then I up the leverage by trading options. So, because I trade options contracts, I have leverage on all of the trades that I put on. And I try to put on option structures that give me grace with my timing. And that's why I don't spend much time on technical analysis. Technical analysis is essentially for the day traders. And I'm not a day trader, I'm a swing trader. So, I mean, technical analysis used solely. I use it, but it's very, very minor. It's a small part of my process. My biggest part is the stuff that I mentioned before. But like I said, I always put on a really nice trade structure of options that will help me to have some grace with my timing. Like, man, I don't have to time it perfectly because I have on such a good trade structure where I can collect some money along the way before, that the long side of my trade gets to um losing too bad or something like that. I know that may be confusing, but maybe, over time, if you're a beginner, I'm not sure, the level uh of expertise that you have, whoever's listening to this right now, because essentially I'm making this for a person who asked me how do I trade, and they told me that they've been struggling, and but I just decided to make this long voice note, essentially and I may share it with other people as well, but that's basically a broad general overview of how I trade and approach financial markets. And the risk and reward for doing it this way is like night and day to anything I've ever seen. It's a true blessing, and I wish that I had learned it a whole lot sooner than right now.